Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in live from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will discuss the latest on mortgage loans, home prices, plus the Federal Reserve's decision on interest rates coming later this week. Today is Tuesday, March 21st, 2023. I'm Byron Lazine, and the Hot Sheet starts now. Somehow we've pulled it off for the first time ever. We are going live from a real estate conference lobby. It is dark here in Portland. We're at the 1,000-watt turn-on event 2023. It is 6:30 local time here on the Pacific Coast. And this is the first time ever this has been done. Mark Davison, co-founder of 1,000-watt, a couple months ago, maybe 2-3 months ago, said, hey, I've got an idea about going live, like Radio Row, Super Bowl style, at a real estate conference. And now we're doing it in the lobby. Usually you see nothing. I don't see one trade booth in this lobby. It's a very unique conference, and it's even more unique now that we are, for the first time, doing a live podcasting studio for the entire conference. So make sure, number one, you're subscribed to the channel, because we will be going live later today, 2, maybe even 3 times going live on the channel from the conference, getting live reactions. Okay, hit the thumbs up. Let's dive into the hot sheet here live from Portland, and we'll start with mortgages. Share of mortgage loans in forbearance decreased 0.6% in February. This just released yesterday from Mortgage Banker Association. Monthly loan monitoring survey that revealed the total number of loans now in forbearance decreased by 4 basis points from 0.64% of services portfolio volume in prior month to this 0.6% as of February 28th, 2003. Okay. 300,000 homeowners right now are in forbearance plans. This is something that real estate skeptics are pointing towards of, oh, wait till all these forbearances, wait till they come to fruition. You haven't been able to foreclose on these homes. There's only 300,000 of those right now that still exist today. The share of Fannie Mae and Freddie Mac loans in forbearance decreased 2 basis points to 0.28%. Ginnie Mae loans in forbearance decreased 9 basis points to 1.28%. The reason the Fannie Mae and Freddie Mac ones are important, that makes up the majority of the loans. Okay, so right now, there's a banking crisis. I just had a conversation with an agent from California this week who texted myself and Tom Toole. She was watching Knowledge Brokers podcast from Friday, and she's like, oh my gosh, we've got this really big deal that is under contract with one of these banks, right? It wasn't SVB. It was the one that's in the news here all the time right now. Not UBS. It was First Republic. I knew if I opened up CNBC, it would just be right at the top because it's all they can talk about. First Republic, by the way, jumps 20% today as some of these regional banks are coming back. But she had a deal with First Republic under contract. And it's like, what do I do? It's not going to close for another 30, 40 days here. There's going to be pressure on those regional banks. Honestly, if I'm an agent representing somebody from, a client who's got a loan with First Republic, I might be looking at backup plans. Okay. I might not just sit there and wait to see what happens. Majority of the banks, though, being our loans being Fannie Mae and Freddie Mac, are a good thing because let's face it, Fannie Mae, Freddie Mac are just an extension of the government, and those mortgages aren't going to go anywhere. Some of these regional banks that maybe aren't Fannie or Freddie, those are the ones that could be on a little bit more dicey ground. Okay. Going back to this update on the mortgages, the forbearance rate decreased for both independent mortgage bank and depository services across all investor types in February. So continuing to go down is what we're seeing on these forbearance numbers. We did an entire hot sheet going real deep on delinquencies, mortgage delinquencies. I don't know if somebody can find that and we can put it linked down below. If somebody wants to find that, with ease in the description. But we went through probably that day 12 to 15 different charts we parsed it down from like 50 on the delinquency situation in mortgages right now. We're at near all-time lows. So everything points towards a really strong mortgage market right now from March 1st. So if you can get that link and just put it down there so people can find that easily. So the March 1st show, when we talked about mortgage delinquencies, that'll be linked down below. Let's go to the slide here, which I will do on this forbearance. All of our slides are going to be available down below for you in the daily download. So this is the percent of servicing portfolio in forbearance by investor type. Okay, so we talked about Ginnie. That is the blue line. Fannie and Freddie is the orange line. And then other PLS portfolio would be the gray line. Total is coming in at yellow. Okay, so again, Ginnie is 1.28%. Fannie Freddie 0.28%. And we've got this PLS portfolio at 0.78%. And then the total is the 0.6% that we started the show. And this is just, I mean, it's dropping off a cliff from what we saw, obviously, in March of 2023 years ago, where we hit 11.8% on Ginnie and 10.93% on PLS. The total was 8.53% of loans back in where it peaked out at 8.53 was about May 31st, maybe call it, in 2020, where 8.53% of all loans were in forbearance, and we're down to 0.6%. The job market, it's incredibly strong. There's 11 million job openings today, and we have we have 50-year all-time low unemployment. So even when people got behind the last 3 years, they were able to catch back up and pay off those mortgage payments. No, I got it, Bobby. Thank you. Producer Bobby is coaching me up on the road switcher, and I appreciate Bobby for helping me. If you can see, you can't see it. You cut it out.
A little bit. You can catch a little bit.
But Bobby purposely cut out the switcher so people didn't know that I was actually producing the show at the same time of talking. Okay, so there you go. That's your update on the forbearances. I do have a little bit more on the loans. And again, you can check out that March 1st show where we talked about delinquencies. The total loan services that were current, not delinquent or in foreclosure, as a percent of servicing portfolio volume decreased to 95.76% in February from 95.86% in January. The 5 states with the highest share of loans that were current as a percent of servicing portfolio: Washington, Idaho, Colorado, California, and Oregon, where we sit right now. The 5 states with the lowest share of loans that were current as a percent of servicing portfolio: Louisiana, Mississippi, Indiana, New York, and West Virginia. Okay, the total completed loan workouts from 2020 and onward, repayment plans, loan deferrals, partial claims, loan modifications, these types of things that were current as a percent of total completed workouts increased to 76% in February from basically flat, 76.03%. Okay, so this is all new information that just got released from MBA. We'll put that down below in our sources daily download link where you can get all of our charts and sources. Okay, we talked about yesterday Lance Lambert's bifurcated market, as he calls it, where you have some towns, some cities, some metros where you have prices declining while you're seeing prices increase in other areas. Most forecasters right now are looking ahead and calling for flat to maybe a couple percentage points up for the entire year. We have seen year over year at this point, we've seen prices come down a little bit, but projecting out strong spring, summer, looking at overall across the country, prices coming out. There are 133 markets that have seen price declines in February, but 267 markets went higher. Okay, so almost 2/3 of the 400 markets went higher, while 1/3 going lower. This is according to the latest Zillow data. At the height of the correction in September, 303 of the nation's 400 largest housing markets saw a month-over-month home price decline by this Zillow Home Value Index. In October, it was down to 292. 245 in November, 256 in December, and now going off of February's number, we're down to 133. That should continue to decrease as we work through the spring market. Tomorrow, we're going to get it today from NAR, but we're not going to actually be able to talk about it until tomorrow. I'll refresh NAR research. They usually do this around 10 a.m. You see a lot of these indexes that we talk about here on the hot sheet typically will release at 8:30 before the markets open. NAR they're typically 10 o'clock. They got to settle into the office over there at NAR. So we'll see that at 10 o'clock. Just going based off of what they reported a month ago, we'll start there. Then we'll look at some of these prices. So median price for 1 month ago, because this data is going to get updated today for January, 359,000 in this country. Depending on the market, you could argue whether that's affordable or not. Okay, so sales January, 4 million units. That's seasonally adjusted for the year. The housing starts 1.309. New home sales, you can see on the screen, 461,000. Okay, so let's focus on the number 359,000 on the median price. They're going to update that again today, and we'll have that update for you tomorrow here on the hot sheet. So make sure you are subscribed so you don't miss it. Now, that's just the median sale price. That's where things were closing out in January, where you typically see a seasonal decline on these prices, right? November, December negotiations usually bring January, February lower prices when you look at the entire year. And then those prices tend to go up into the spring market. Median home list prices right now, this is according to Altos Research. Again, this is available for you down below. The median home list prices, the median mark that homes are going onto the market, okay, is 429,000. Median price of new listings, all right, so those new listings that are coming onto the market, which we know, we talked about yesterday, has dropped significantly again. We need new listings. We saw inventory rise for the first week in a while. We talked about that yesterday, but new listings continues to decline. Median price of new listings is down to 400,000. Okay, so the median home price of properties that are on the market, that are the inventory that we have, is 429,000, up from 399,900 this time last year. But these new listings coming on, they're a median price point of 400,000. Going over to the median price of home sales in contract, so pendings or in escrow, whatever you call it in your market, for U.S. single-family homes, is $375,000. So you see where the market, the activity in this market is. We're down 38% on mortgage applications right now. So we know, I don't care what anybody's posting or talking about, how they're saying, hey, activity's really high. It's down 38%. Demand is down 38%. But when we look at this chart, it tells us, where is demand the highest? It's high on the median price points. We talked about NAR being at $359,000 in January. We're going to find out what it was for February for median prices. And so what do you know? List price of homes in contract, $375,000. That tells me that median price could tick up a little bit when we look at February, when that information comes out today, because the properties in contract are at a median price point of $375,000. That's flat year over year. So we're starting to see some resistance there on the homes in contract. And obviously, this is where the most demand is going to be. Anything near median price point, you get below median price point, you have serious demand. That's where you see multiple offers in almost every community in America, anything below median price point. Let me know in the comments what you're seeing at median, just above, or just below median price points in your market, and where you are tuning in from today. Okay, that's your update on prices. We'll have a further update tomorrow with NAR, and we'll revisit if there's a big shift. I'd imagine, if I'm predicting, I like to throw out some of these predictions once in a while. January is 359. We have a median price of 375, like we just talked about, probably be in the 360s. And that's not that hard of a prediction. So you can roast me in the comments for that prediction if you'd like. Okay, moving to the big news of the week, what we're all waiting for. What is Jay Powell going to do tomorrow? The FOMC decision. They're meeting today. They're meeting tomorrow. I wonder, I'm always curious, because they don't have like a social media account, what they're going to be having for lunch, what kind of amenities they're going to have. They go to these fancy retreats every year to Jackson Hole. So I'm just curious, like, are they going Uber Eats, or is it like some really fine dining experience as they go over all these numbers? Obviously, the committee is going to pool all of their thoughts together. They're going to kind of come out with a consensus basically tomorrow when they decide what they're going to do with this federal interest rate. Let me go over to Wall Street Journal, which I thought broke it down this morning pretty well. Here we go. Federal Reserve faces a tough decision on this rate increase. Okay, so his colleagues are going to face one of the toughest decisions all year. That's because of this increased or this intense banking crisis, the most intense crisis we've had since 2008 for the banks. The decision on whether to raise the interest rate by a quarter percentage point. About, I would say, what are we at? March 21st right now. So 10 days ago, let's call it the 13th, we were at 66% of the market was pricing in a 50 basis point hike. Today, that number is basically flipped to the 25 basis point. We're at 66% today, market pricing in a 25 basis point hike for the interest rate release tomorrow. That's up from 36% on March 13th. Okay, so we don't know what they're going to do, but that's what the market is pricing in. Okay, you actually see the stock market up today. Last I looked, we were up. Let's take a look. Yeah, we're up. That was up pretty big, 300 points. Tells me that the market believes that they already have an indication of what the Fed's going to do tomorrow, that 25 basis point hike that they've been pricing in the last week is what's going to happen. They're up 300 points on the Dow. S&P's up 1%. NASDAQ is up over 100 points. So big increase for the NASDAQ, up almost a full percent as well. Okay. So the Fed's tried the last 2 years to telegraph its rate moves to avoid surprises, right? Minimize the volatility. We've seen a super volatile market in a lot of different ways. But until now, it hasn't confronted such an abrupt situation. This is reading directly from Wall Street Journal right now, and fluid crisis on the eve of a policy meeting. A lot of people are saying, hey, just pause and see what happens. There's so much pressure on banks, specifically right now, these regional banks, that if you put any more pressure on them, you could see a situation like we've seen the last couple of weeks on a run on the banks. Treasury Secretary Yellen says that the government could backstop more deposits if necessary, but they haven't come out and said that that's what they're going to do. They're saying they could do it. That means that they will pick winners and losers. They don't have the money to guarantee deposits across this country. That's why they haven't come out and said, yes, we're going to guarantee deposits across this country. If they were going to do that, they'd have to get the money printing machine back up and running. And we know what's going to happen to inflation there. So they're in a tough spot where it's like, hey, we just hope people don't make a run on the bank. We're going to say things like this, Secretary Yellen, where, okay, we could backstop more deposits. We're not going to say that we're going to do that, because if we say we're guaranteeing that, we've got to go out there and print more money, and inflation is going to take over. And that's what we're trying to combat right now, and trying to get down to that 2% level. Okay. So we're going to wait and see. We're not going to even know tomorrow when we do the hot sheet where they're at. Maybe we'll get, some information that'll leak. And we'll have some, maybe a better feel tomorrow, but it looks like a 25 basis point. Jared says, I think no increase would be good. I would be in your camp, Jared. Fed has said that it takes 6 to 9 months to see effects of raising rates. meaning we're seeing effects from September. They should hold off for 3 months. They should certainly hold off this month, right? May we're gonna get a lot of this. We're gonna get this inflation data, I believe, on May 10th, where it's really gonna tell us how much the lagging data that we're waiting for on shelter, on housing, how much it's actually come down. And if that number comes down significantly, we'll be in a good spot. You can put up that other Jacob. Moving to, oh boy, I don't know the word. Des Moines? Des Moines. There you go. Terrible. I'm awful when I'm reading. I've got people here laughing at me. If I'm reading a location I've never seen, it's going to be bad. All right. Manoy. There you go, Jacob. Properly priced. I couldn't read it. Properly priced homes in our market under our median price point, often still seeing multiple offers. Absolutely. So I wonder if that's the median price point. Jacob, South House Living, median sales price in Houston down 3.9% in February and 2.6 months of supply. Interesting. Okay. So Houston's actually seeing median price points down. I know we've had some other comments from the Houston area that are very similar to that. So Houston would be an outlier on median price points that are actually moving down. Another area would be Austin. Okay, so those areas that have had massive growth, Houston, Austin, the last couple of years, we're actually seeing those median price points come down. Okay, there we go. Let's take a look at the 10-year really quick before we started the show. It was actually up quite a bit. Makes sense because the markets are up. We know that if we want to follow what's going to happen with housing, we've got to follow this 10-year, and we're up almost a tenth, 0.01 here. We're up 0.099. I'm sorry, we're up 0.099 on the yield, so we're at 3.585. Decent size jump here on the 10-year, so we likely will see a 30-year that jumps back up today. And we ended the day. We had 2 readings yesterday on the 30-year. We ended the day at 6.67. We ended Friday at 6.55. We could be back in the 6.7s. It looks like we certainly will, probably 6 3/4, according to Mortgage News Daily on their daily survey. When that comes out later today, probably 6 3/4. We would like to get it closer to 6. We know what that does for activity. Okay, there we go. That is your hot sheet here, live from Turn On 2023, Portland, Oregon. We're going to be going live probably in another, what time is it? 7 o'clock. Keep an eye on BAM YouTube. Bobby doesn't want to guarantee any times right now, but I would say keep an eye, probably 8:30. We'll get some reactions of people going into the event. They open the doors here, I believe 8:30. What time are we opening the doors? 8:30. So they're going to open the doors. We'll probably go live shortly after that. You can plan on us going live noontime here, or just about noontime, which is 3 o'clock Eastern. So those are going to be some of the opportunities to jump into the live tab. Make sure that you're subscribed to the channel. Also, we're about to record right from here, The Real Word, which will be up premiering on the channel at 2 p.m. And I believe we have a brand new ebook. We're like releasing ebooks every single week. So if you're creating content and you're looking for Instagram or TikTok, green screen help, we have a brand new ebook, totally free. Download that with the link below. All right. Stay with us because we're going to be going live all day from 1000 Watt Turn On. And until the next live stream, toodaloo.